Welcome to this lecture on tax avoidance. Now, you've all heard this phrase or this saying where they say that there's a difference between tax avoidance and tax evasion. And of course, that is very true. Tax avoidance means you are avoiding to paying unnecessary taxes, whilst tax evasion is when you are deliberately lying or hiding information from SARS in order to pay less taxes, and that is of course illegal and it's fraud. So tax evasion is unethical and obviously not something that you can do or should do, and you never ever advise clients to do so either. Now, you are allowed to avoid taxes, and there's a whole discussion in South Africa about if there's a possibility where you can avoid legally taxes, should you still have an ethical responsibility towards to the country and towards contributions to the government, that you still choose the option which maybe has a little bit higher tax, but it may be a more ethical decision. Now that's a consideration for people, and that's something that people grapple with and talk about, because obviously we know that money doesn't always get used as it should. But why I'm bringing this up is just to tell you that tax avoidance in itself is also an issue which is quite often discussed. Now, let me just give you a quick example here of something I want to illustrate. Mr. X is 70 years old. He wants to move to a retirement village. He sells his house to his son. He has two options. One, sell the house for 1.9 million rands. Two, sell the house and as payment his son gives him 10,000 rands per month. Now, let me explain what I mean. So Mr. X sells his house, he's 70 years old, he has an option to sell it to his son. He can either sell it for 1.9 million or he can sell it for 10,000 rands a month. Now what I mean here, obviously I don't want to write it all out, but what I mean here is his son will pay Mr. X for as long as he's alive. So if Mr. X lives for another 5 years, his son will pay him 10,000 rands a month for the next 5 years. If Mr. X lives for another 30, 40 years, then his son will pay him 10,000 rands a month for the next 30 or 40 years. So as you can see here, the idea here is that depending on how it works out, someone either gains or loses from it. Now, Mr. X has this option. If he does it, so let me tell you what I mean by this. If he chooses option 1, this house is sold for 1.9 million rands, less than 2 million rands, so there will be no CGT implications. It's capital in nature, so there's no tax implications for Mr. X at all. But if he sells it for 10,000 rands a month, that 10,000 rands a month is an annuity. And an annuity is included per paragraph A of the gross income definition in gross income. So then Mr. X will be taxed on 10,000 rands a month. He'll have to include it. So what am I trying to say to you? In option 1, there's no tax. In option 2, there is tax. Which option is the correct option? Either one of those. Now, if you're advised to give it, you need to obviously read what the questions ask you in an exam. If it asks you to just give advice, then you will explain the implications. If it tells you to recommend one which results in the least amount of tax, then you will do so. Okay, but that is the idea behind that. Neither of those are illegal. So which are the sections that we cover for evasion? It's section 103.2, which deals with assessed losses. Section 103.5, which deals with income-dividend swaps. And section 80, capital A to L, which deals with impermissible tax avoidance arrangements, which is a big mouthful. So we'll talk about section 103.2 first. Okay, now, Here's a company, XPTY Limited. It has an assessed loss of 100,000 rands. Now guys, you'll remember when we studied section 20, you studied things like the SA Bazaars case, which said there's rules which says a company, if they have an assessed loss, will lose that assessed loss if they stop trading. Okay, but let's now assume XPTY Limited has an assessed loss in the prior year that it's carried forward. It's not stopped trading, but it's not doing well. Now, if XPTY Limited in the current year makes an income of 300,000 rands, let's say, that section 20 loss can be deducted against it. So we're all happy with that concept still. So this 100,000 reduces your tax. Now, this company has an assessed loss of 100,000 rands. Another company called A Limited sees this. A Limited, and XPTY Limited is planning on shutting its doors. A Limited purchases 100% of XPTY Limited for 1 rand, or whatever the amount might be, because XPTY Limited might have a lot of liabilities, so that it's worth nothing. But now, what happens? A Limited is now the owner of XPTY Limited. So A Limited has a business. A Limited could now take income and put it through XPTY Limited, right? So it'll obviously be invoiced by XPTY Limited. But he can, what I'm trying to say here is A Limited can use that 100,000 rands. You can filter income through it. And this is something a lot of you, when you are busy doing your articles, will find customers and clients that have lots of dormant old companies. A lot of times this is the reason why. It's because they purchase these companies to use assessed losses. Now, SARS does not like that. Because the idea here is that XPTY Limited generated a loss from its own operations, and that's the company that should only use it. External people, new shareholders, shouldn't just come and acquire this company just to use that. SARS does not want that. So section 103(2) exists that says, whenever the commissioner is satisfied that there is any agreement that affects a company or a trust, or there's any change in the shareholding of a company, or the members in a closed corporation, or the beneficiaries of a trust. So up to there, I just want you to see two things. There's either any agreement. Now, any agreement means it's not just buying shares. I can make, A Limited can make an arrangement with XPTY Limited where it says, okay, what we want you to do is to filter, we'll cede some of our sales to you, and then you give us a service fee, or you can make any arrangement, right? Or if there's a change in shareholding, and I say, and as a direct or indirect result of that, income has been received, or there is proceeds from the disposal of an asset, and it has at any time been entered into or affected by any person, here we go, solely or mainly for the purpose of utilizing an assessed loss, as the case may be, in order to avoid the liability for the payment of tax, or to reduce the amount thereof. Then the set-off of such an assessed loss shall be disallowed, or if it's a capital gain, it'll be disallowed against the assessed loss. Now, so what do they say here? They say, if A Limited buys XPTY Limited, and the sole or main reason for buying it is to use that assessed loss, then that assessed loss will fall away. So if there is income of 300,000 rands, this assessed loss will just fall away per section 103(2). If it is not the sole or main reason, then you can still use it. Alright, this also applies to capital losses. Now remember, when you do CGT, you put all sorts of amounts in your CGT column. At the end, you add it all up. Then you say that's the aggregate capital gain. From that, you deduct your capital loss brought forward. That capital loss over there has the same idea. If XPTY Limited had that capital loss and A Limited bought it for the sole or main reason to use that capital loss, so then they disposed of assets through it, then it will be disallowed. Right, so guys, the idea here is that you can't use it for the sole or main reason. You have to use it for a valid business reason. So this will be something that you have to prove to SARS. So, for example, let me give you an idea. A Limited, XP2I Limited might be a company with a broadcasting license, let's say. And A Limited is a media company, makes media content, videos and things. A Limited wants to get into the broadcasting game and broadcast onto TV. So A Limited buys XP2I Limited for the reason of getting this broadcasting license access. But XP2I Limited has an assessed loss. In that case, SARS doesn't have an issue with it. They say, cool, you can use the loss. Because the reason why you're buying it is for this license. But you have to prove that to them. Then we have section 103.5, the income-dividend swap section. Now, this is quite a nice section. Let me explain to you. So let's take the SPCA. The SPCA is a public benefit organization. All right? So what do we know about that? Is exempt from tax. Okay, so if the SPCA receives any money, it doesn't pay tax, so it's exempt from tax. Now the SPCA has an investment in shares, earns a dividend of 100,000 rands. Okay, so if you do the tax calculation of the SPCA, it'll be like this. You'll say dividend received, and you won't even show the exemption. You'll just say it's a PBO, so it's exempt from tax. So there's no tax. Now we have X Limited. X Limited earns service income. Right, it rents out services, 80,000 rands. When X Limited does its tax return, it looks as follows. Services includes 80,000 rands. Now XP2I Limited, well actually let's do it like this. Let's actually make it a better example. XP2I Limited earns 120,000 rands. Okay, tax 28%, 33,600. So that's net. So how much does this company get after tax? It has 86,400. Okay, so what I want you to see is these two taxpayers enter into an agreement. X Limited says to the SPCA, I will cede my 120,000 rands to you. Ceding means give it to you. So we say whenever X Limited receives its money, it belongs to the SPCA. So the SPCA will get 120,000 rands. In return, the SPCA will cede its dividend income to X Limited. So X Limited gets 100,000 rands. Now why would they do that? SPCA is now getting 120,000 rands instead of 100,000 rands. What is going to happen here in its tax calculation? Instead of having a dividend received, it will now have service fees received, but it's still a public benefit organization, so it still doesn't pay any tax. So the SPCA is still in a null position for tax, but it has 120,000 rands. What happens to X Limited? X Limited, so we had a service fee of 120,000 with tax. That's no longer going to be the case. This is what's going to happen now. X Limited will receive a dividend of 100,000 rands. Dividends are exempt in terms of section 10(1)(k). So there's no tax. So how much money does X Limited receive now? 100,000, that's the net amount. It previously received 86,400. So can you see everybody wins here except for SARS. SARS loses out. Now this can't happen. So section 103.5 says, where there's any transaction and any taxpayer has ceded the right to receive any amount, so X Limited cedes its right to receive this service amount, in exchange for the right to receive an amount of dividends, because they say we want your dividends instead. And in consequence of that cession, the liability for normal tax of the taxpayer or any other party to the transaction has been reduced or extinguished. And remember, here, the tax was 33,600, now the tax is null. So it has been reduced or extinguished. Then the Commissioner shall determine the liability for normal tax, as if such cession had not been effected. So, if section 103.5 applies, remember this is what we looked at, this situation now. That's what it would be, right, if they just made this arrangement. But if section 103.5 applies, then they ignore the ceding and they go back to the original situation. So they would calculate it as if the ceding never took place.